Chief Investment Officer, O'Neill Global Advisors, joining us. Thank you very much, Randy, for joining us this early in the morning. Well, first up, what's your guess about how the dollar is headed? It looks like the dollar index weakness is helping emerging markets. Do you see that continuing and therefore a tidal wave of dollars flowing into EMs like India?
We do see that continuing. A couple of points, as you mentioned. The dollar is in a downward move right now. We think it's likely it could go back and retest at least its 2018 lows. That is helping emerging markets. We think that's going to continue. We also think that some select emerging markets may have better economic growth than the U.S. next year, as the U.S. has obviously been hit very badly by the pandemic, and it's taking a major toll on the U.S. economy.
Okay, in that case, what's your view of India? Where does it rank in your pecking order? And at the moment, the Nifty is trying to push past 11,000. At this level, do you find India attractive?
We like India very much on a secular long-term basis. Obviously, there hasn't been, fortunately, the death count in India from COVID, but there have been obviously quite a few cases, well, over 1.8 million. India is not our favorite market right now out of the emerging markets. We've actually favored some of the Asian markets, including China. Within India, we continue to like big technology, healthcare, and some of the consumer names like Tata Consumer Products and Britannia Industries.
Okay, that's interesting. Randy, good morning. Is there a bit of a risk factor for the market? Are we seeing some kind of equity melt up? Which perhaps post-US elections could see a sharp meltdown as well? Because there are still concerns. The COVID problem has still not gone. The economy is still struggling in a lot of places, even in countries like India.
I think the two or three points I would make are, first, when you think about global markets and the U.S. market, the U.S. Fed has really increased its balance sheet. So if you go back to last September, the Fed's balance sheet was a little bit over $3 trillion. Today, it's a little bit under $7 trillion. So that's a huge expansion in the balance sheet of the Fed, and that has provided liquidity to the U.S. markets. U.S. money supply is growing about 25% a year right now. So that's provided a large underpinning. So that's my first point. My second point is as we go through earnings season in the U.S., about 75% of the S&P 500 as reported, they had very low earnings estimates going into earnings season. So about 84% of companies have beaten on the upside. But if you look at the forward growth numbers, they continue to come down. Right now, we're expecting about a 10% drop in earnings for the S&P for calendar year 2020. The market's actually forecasting a 16% increase next year, and we are a little nervous that could be optimistic. The market's trading at about 21 times earnings right now on 2021 estimates, so it is richly valued. Clearly, we need the Fed to continue to support the market. We also need more fiscal stimulus out of the U.S. government, as you mentioned earlier, I think, for the economy to be able to recover.
Okay. Randy, hi, morning. Let's come back to India now, because you mentioned that you like some of the consumer names like Tata Consumer and Britannia. You also fleetingly mentioned that you like technology stocks. Which are the stocks that you prefer, and any other stocks in the Indian market that catch your eye?
We like some of the big outsourcers like Infosys, like Tata Consultancy. I do think that technology in the longer term, technology, healthcare, and retail continue to be kind of the global drivers sectorally, both in the U.S. but also in India, and those are spaces we continue to like. We do think the COVID pandemic has really increased spending in the technology area, and some of the major India outsourcers should actually benefit from that.
Okay. Randy, I wanted to, you started your discussion by speaking about the theme of weaker dollar. That's helped metals a goodish bit. Where do you stand? Would you buy steel stocks in India or anywhere else?
There's really sort of two areas of commodities that are doing well. The first, is one of your guests mentioned earlier on the show, is gold and silver. And I think what's happening with precious metals is they're really acting as a store of value. And I think investors see what's happening with money supply, and they see what's happening with the Fed balance sheet. And so they're buying those metals as a defensive store of value. And we actually think they look very good longer term. We continue to like them. The other area of commodities that have done well have been some of the building and housing related commodities in the U.S. The commodities that are weak, though, which we don't think are on the same trend, are first fossil fuels. Obviously, oil is down, I think, about 32% year to date. Natural gas has been weak. And also, actually, a lot of the food commodities have been weak as well. So in the commodity sector, we really prefer either precious metals or commodities that are building related. And we would avoid the energy sector for now.
Okay, avoid energy sector for now. Randy, since you are tracking Indian stocks so closely, I wanted to check if you have any view on the two biggest stocks, Reliance or HDFC Bank, and whether you would have them in your portfolio.
We prefer Reliance Industries much more than the financials. Obviously, the RBI has a meeting in a day. It looks like there's a decent chance of a rate cut there. I think financials are going to continue to have a hard time with that net interest margin under pressure, and that's true also in the U.S. So we really prefer companies that are not as financial oriented. So between the two, I would definitely favor Reliance.
And finally, Randy, this is a question we put to everyone like a broken record. This disjoint between markets and macros. You yourself are not terribly confident of the US economy growing as much, and you're worried about valuations. This huge liquidity-driven rally, does it continue? The Fed put always works, or are there red flags?
Well, for right now, the Fed said recently that asset purchases are going to continue at their current rate. And, the one rule I learned early in my career was don't fight the Fed. So I think for now, the markets are assuming that there is a Fed put underlying the markets. I do think, though, that for this rally to continue longer term, we're going to need to see, obviously, COVID cases start to drop in the U.S., and we're also going to need to see more fiscal stimulus out of the U.S. government. I think it's important we get this bill. I'm hopeful we will get it, but if we don't, I think that would be a major negative for the economy. I think what I would tell you is that here in the U.S., small business is really struggling right now.
Okay, Randy, it was really a pleasure speaking with you. A wholesome interview, not just about the macros, but the micros in the Indian markets that you track so closely. Thanks so much for joining in and giving us your views. Well, that's the word coming in over there. They like the Indian markets quite a bit. And some of the themes like technology, pharma, something that they prefer. Let's slip into a short break on that note. When we come back, our entire research team